SAP just delivered a quarter that looks surprisingly strong on the surface. Cloud growth accelerated, the backlog remained powerful, and customer demand showed little sign of slowing. But then something didn't quite fit. The company lowered its operating profit outlook, even as it maintained its cloud revenue expectations. So what actually happened? Was SAP facing a deterioration in its core business, or was management deliberately accepting near-term pressure to fund something else? And why did investors react so positively when part of the profit outlook moved in the wrong direction? The headline numbers tell us what happened. They don't tell us why. And that is where this quarter gets interesting. Because behind the revenue, backlog, margins, and guidance is a series of management decisions about where to invest, where to cut, and what to prioritize next. So let's look underneath the numbers. The first thing to understand is that SAP's quarter was not simply about beating or missing expectations. The underlying growth picture was strong. Cloud revenue continued to expand, cloud ERP remained a major growth engine, and current cloud backlog increased significantly. That tells us customers were still committing to SAP's cloud business despite concerns about enterprise software and AI disruption. But a strong growth number doesn't automatically mean the quarter was perfect. The more important question is what actually drove that growth. Was it new customer demand, cloud migration, stronger commitments, or something else? Because revenue tells us what SAP delivered. Backlog may tell us what customers are willing to commit to next. And this is where the quarter becomes more interesting. SAP's current cloud backlog reached about 22.9 billion euros, increasing 26% in constant currency. Unlike quarterly revenue, backlog gives us visibility into business that has already been contracted but will be recognized over time. That distinction matters. A company can report strong revenue because of what happened in the past. But a growing backlog tells us customers are still making commitments today. And SAP's customers were doing exactly that. The key question is why. If companies were becoming cautious about enterprise software because of AI and economic uncertainty, we would expect new commitments to weaken. Instead, SAP saw continued strength. So the backlog doesn't just support the revenue story. It gives us the first clue about what is actually driving this quarter, and what management expects to happen next. The next question is where that backlog strength is actually coming from. The answer points directly to Cloud ERP. SAP's Cloud ERP suite grew 27% in constant currency during the quarter, reaching about 5.5 billion euros. This matters because it shows customers are continuing to move critical enterprise workloads into SAP's cloud environment. But the important question is why demand remains strong now. Is SAP benefiting from faster cloud migration? Are companies consolidating systems? Or is AI making modernization more urgent? We don't need to assume the answer yet. What matters is that a major part of SAP's growth is coming from customers committing more deeply to its cloud platform. And that creates the next question. If growth is this strong, why did the profit story become more complicated? So far, SAP's quarter looks strong. Cloud revenue is growing, cloud ERP remains a key driver, and customer commitments continue to build. But the profit picture tells a different story. SAP kept its 2026 cloud revenue outlook unchanged, yet lowered its operating profit outlook. That creates the central tension in this quarter. If the growth engine is still working, why is profit coming under pressure? The answer is not obvious from the headline numbers. We need to look between revenue and operating profit and understand what changed during the quarter. Was SAP spending more? Were acquisitions affecting profitability? Or was the underlying business actually weakening? The numbers tell us that something changed. The next question is why. The answer points to management's decisions on where to invest. SAP said the lower 2026 operating profit outlook was primarily driven by the dilutive impact of recent acquisitions, including Dreamio and Prior Labs, which together are expected to reduce operating profit by more than 100 million euros. But acquisitions were not the only factor. SAP also accelerated R&D investment, while the Relshio acquisition added further dilution. The comparison with Q1 was also affected by unusually low stock-based compensation. So this was not simply a story of weaker demand. SAP was accepting near-term profit pressure while continuing to invest behind its growth strategy. Now the important question becomes whether management believes those investments can generate enough future growth and productivity to justify the cost. The important distinction is what management did not change. SAP maintained its 2026 cloud revenue outlook even after lowering operating profit guidance. That suggests the profit pressure was not being accompanied by a deterioration in the company's core growth expectations. The spending decisions also give us context. SAP had just completed acquisitions including Dreamio and Prior Labs, while continuing to accelerate R&D investment. These decisions create costs before their potential benefits appear in revenue or productivity. So the quarter looks less like a sudden operating breakdown and more like a business absorbing the cost of investment. But investors cannot judge this simply by asking whether management is spending. The real test is whether those investments can strengthen growth enough to offset the near-term pressure. That is why management's commentary matters next. Management's commentary helps separate the two sides of the quarter. Christian Klein emphasized strong current cloud backlog momentum and continued customer demand, while CFO Dominic Assam pointed to sustained growth and disciplined execution. The cautious message was concentrated on profitability, particularly the impact of acquisitions and increased investment. That distinction is important. Management was not telling investors that customers were pulling back. Instead, it was signaling that SAP was continuing to invest while absorbing some near-term earnings pressure. The tone therefore remained confident on the business trajectory, but more measured on the cost of executing it. Now we have to test whether that confidence is supported by actual customer behavior. And this is where AI becomes relevant, not as a long-term story, but as evidence from the current quarter. AI clearly appeared in SAP's customer discussions during the quarter, but we need to separate adoption from monetization. SAP said more than 90% of its top 50 deals included an AI component. That is a strong signal that AI is becoming part of enterprise purchasing decisions. But it does not mean AI alone generated the quarter's growth or has already produced a large incremental profit contribution. What it does show is that SAP is positioning AI inside the cloud relationships customers are already expanding. That helps explain why management continues investing in R&D and AI capabilities despite near-term margin pressure. The evidence is therefore stronger for AI adoption than for direct AI monetization. And that distinction matters when we look at the outlook. If management is confident enough to maintain its growth targets, what exactly is supporting that confidence? This is where management's confidence becomes easier to judge. Despite lowering the operating profit outlook, SAP did not reduce its core growth expectations. The company maintained its 2026 cloud revenue outlook at 25.8 to 26.2 billion euros and continued to target around 10 billion euros in free cash flow. That combination is important. If management believed demand was weakening, we would expect the cloud outlook to come under pressure as well. Instead, SAP is maintaining its expectations for the revenue engine while accepting some near-term profitability pressure. So the guidance change appears to be more about the cost of executing the strategy than about a deterioration in demand. But guidance is still only a promise. The next question is whether investors believed management, and the market reaction gives us the strongest clue. Now the market reaction gives us another important piece of the puzzle. SAP's shares jumped roughly 10% after the earnings release, with the strong growth in current cloud backlog highlighted as a key reason for the positive reaction. The stock then continued to strengthen in the following sessions. Why did investors react so positively when operating profit guidance had been reduced? Because the market appeared to focus on a different risk, whether AI and changing technology spending patterns would weaken SAP's cloud growth. Q2 provided evidence pointing in the opposite direction. Cloud revenue remained strong, cloud ERP continued to grow rapidly, and current cloud backlog expanded 26% in constant currency. So investors were not simply ignoring the profit pressure. They were reassessing the risk behind it, and placing greater value on future revenue visibility than near-term earnings. The market has given management the benefit of the doubt, but that confidence now has to be earned. The next few quarters will show whether SAP's decision to accept near-term profit pressure is producing the results management expects. The first signal is cloud growth. If cloud revenue and current cloud backlog remain strong, the investment thesis becomes easier to defend. The second is profitability. Investors will want to see whether acquisition-related dilution and higher R&D spending begin to stabilize. Free cash flow will also matter, because strong accounting growth is less convincing if cash generation weakens materially. And there is one more test, AI. If AI-related demand increasingly appears in large customer deals, SAP will have stronger evidence that its investments are translating into commercial momentum. The strategy now has to move from spending to results. The real story behind SAP's quarter is not simply that cloud growth was strong or that profit guidance was reduced. It is the trade-off management chose to make. SAP protected its cloud growth outlook while accepting near-term pressure from acquisitions, higher R&D investment, and other costs. That tells us management is prioritizing the expansion of its growth engine rather than maximizing short-term operating profit. For investors, that changes how this quarter should be interpreted. The key question is no longer whether SAP can produce strong cloud growth. The next question is whether management can convert that growth and investment into stronger earnings and cash generation over the next few quarters. So Q2 was not just about the numbers. It was a test of management strategy, and the market has decided, for now, to give SAP the benefit of the doubt. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.